When you begin your investing journey, you may want to consider which strategy you'll use. If you pay close attention to market reports, you'll know that stock values fluctuate all the time. Two options investors may consider to maximize their earnings are time in the market and timing the market. In this episode, we'll walk you through the differences between these two investing strategies and the top 4 reasons time in the market is better than market timing. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the best stocks to include in your investment portfolio. What is market timing? Market timing refers to any predictions an investor makes about price movement. When an investor thinks a stock price will be above or below a certain price on a certain day, that is market timing. These sentiments can stem from any number of ideas or assessments, such as studying a historical price chart and attempting to learn patterns. Market timing can apply to any security. Stocks are the most common example, but someone can also use market timing to guide their bond, gold, or real estate investments. Anything that's subject to market forces could be traded with market timing. How does market timing work? Market timing can be employed as an investing strategy in many ways. It all depends on what exactly an investor thinks will happen. For instance, if an investor sees a stock trading at $80 on Monday and they feel it'll drop down to $78 by the end of the week, then they may short the stock or buy a put option that expires Friday. Both of those trades are bearish. They depend on the stock price going down to make money. If the stock price falls as the investor hoped, then they make money. If the stock price rises, then the investor's market timing fails and they lose money. The opposite works as well. If an investor thinks a stock price will rise, they may go long on a stock or buy a call option that expires on the day they think the stock will rise by. They may even use margin debt to act on their sentiment, adding extra risk to an already risky strategy in hopes of sudden riches. If an investor sells their stock because they're afraid about an impending stock market crash, that's another example of market timing. This particular example shows the high levels of risk and reward that come with market timing. Even if it's clear that an asset bubble is forming, it's incredibly rare that someone accurately predicts a crash to the day. However, if someone manages to do so, they'll be able to buy back into the same positions at a much lower price. Advantages of using market timing strategy. The benefits of market timing strategy are as follows. Market timing is used to maximize profits and offset the associated risk with high gains. It's the classic risk-return trade-off that exists with respect to investment. The higher the risk, the higher the return. It enables traders to curtail the effects of market volatility. It enables traders to reap the benefits of short-term price movements. Disadvantages of using market timing strategy. Empirical research and real-life incidents show that the costs associated with the market timing strategy greatly surpass the potential benefits, given that it requires a trader to consistently follow up on market movements and trends. It entails higher transaction cost and commissions and includes a substantial opportunity cost. Market timers exit the market during periods of high volatility. Since most market upswings occur under volatile conditions, active investors miss out on the opportunities and ultimately earn less returns than buy and hold investors. An investor who succeeds in buying low and selling high must incur tax consequences on their gain. In case the security was held for less than a year, which is mostly true for market timers, the profit is taxed at the short-term capital gains rate, which is higher than the long-term capital gains rate. Precisely timing market entries and exits may be difficult. What does time in the market mean? Time in the market means relying on a strategy where you don't try to guess when the market is at its lowest or highest point. Instead, you buy the market knowing that your timing is probably going to be off, but that eventually the fundamentals matter more than the timing. The time in the market investor will then stick with the market until the original reasons for buying change or they've reached their intended goal, e.g. they're now approaching their retirement years. Top 4 reasons time in the market is better than market timing. Here are 4 reasons why entering the market sooner is more critical to your success as an investor than how the market happens to be faring at the moment you enter. 1. It allows you to take full advantage of compound interest. Compound interest is the process of earning interest today on the interest that you've already earned in the past. It's a powerful force and it can amplify an investor's investment in incredible ways. For example, let's say that you've invested $500 per month for 30 years and your investments enjoyed a 7% average annual rate of return. In 30 years, only $180,500 of your $570,570 portfolio balance would have been due to your contributions, or the rest would have been accrued thanks to compound interest. And this isn't an anomalous example. For the vast majority of us, compound interest will be responsible for the lion's share of our final portfolio balance. 2. It ensures that you don't miss the market's best days. The biggest danger of trying to time the market is that no one really knows when the market will hit bottom. And history shows that once it does, it tends to rebound very quickly. In fact, often the majority of the stock market's annual growth will take place within just a few trading days. Missing out on the huge gains that happen during the best days of the market can significantly reduce your overall return. 3. It allows you to continue collecting dividends. If you plan to take a dividend investing approach, market timing is even a worse idea. Let's say that you're considering a stock that you plan to buy 100 shares of Johnson & Johnson, a stock that currently pays $4.04 annual dividend. In other words, 100 shares of J&J stock would pay you over $400 per year in dividends alone. By waiting just 3 years to invest your money, you would have already missed out on over $1,200 in dividends. That's money that you would have earned regardless of how the stock performed. Even if the stock declined during those 3 years, you would have been paid handsomely to wait for a rebound. And there's another reason why dividend investors want to invest as soon as possible. Strong dividend stocks have a reputation for increasing their dividend over time. To use J&J as an example again, they've raised their dividend by 17 cents since just 2018. 4. It enables you to automate your investment. The majority of us aren't professional investors, therefore we don't have the time to research companies in depth like Warren Buffett or Peter Lynch to decide when to buy or sell them, which is why both of those investing legends are huge proponents of buy and hold investing for the average investor. Most of us are busy enough with our day jobs, so trying to decide when to get in and out of the market often just adds a lot of extra stress. But with a long-term approach, you can fully automate your investing. And an automated or passive investing strategy can dramatically reduce your anxiety and keep you from panic selling during times of market volatility. It can be said that it's never too late or too early to start constructing and building one's portfolio, no matter the individual's age. Key to diligent investing is not attempting to cherry pick and time the market, but instead spend time in the market and ride the historical wave of unhurried but continuous growth. The earlier one begins their investment journey, the more funds will be accumulated when the time comes to stop work. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes of financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a copy from the link in the description. Good luck and see you in the next episode.